A lot of you guys are brand new investors and you've been constantly asking me, what is the best type of investment to get into? So today I'm going to be doing a full tier list of all the different ways that you can invest in your money to see which ones are the best and which ones you probably not do for a while. So let's get into it. So first one we have is bonds. And what bonds are is this is debt. So when a company raises money, they can either raise it as stock, meaning you own like a portion of this company, or as debt, meaning, hey, let me borrow money from you and I'll pay you back the money at like 5% interest over time. You know, bonds are pretty good because they are like guaranteed. If the company goes bankrupt, then anyone who owns the stock is screwed. Like the value of the shares are worthless. But anyone who owns the debt gets paid back first as like a priority thing. So it is a safer investment, but the downside is you don't get that bonus like when the stock appreciates in value. So for that case, I'm gonna call bonds at a B level. Bonds are very stable. They don't grow as much and they're really good for your like overall portfolio. And as you get older, you want to be less risky and you want to have more of a stable investment. So when you're younger, you want to have more stocks and less bonds, but when you're really old, you want to have more bonds and less stocks. All right, the next one is a certificate of deposit. So what this is when you go to a bank, you can open like a checking account, a savings account, or put your money into a CD, which means that you lock your money away for like 3 months at a time, 6 months, 1 year. And the longer you lock your money away, the more interest they will pay you on that CD. Now, the thing is, because they lock your money away, I already don't like this investment. I like my money more liquid or has the potential to grow a lot. The thing is, when you lock your money away with a CD, the interest they pay you isn't even that crazy. So to me, this one's not very high, and I'm gonna put this at a D tier. But the next one is cryptocurrency investing. So that's like buying Bitcoin, Ethereum, etc. And I'm just talking about buying the tokens. The thing is with this one, it is very, very unstable. As we've seen, they go up, they go down. Right now, they're very, very high, and I think a lot more people will buy into it. But there are so many different types of cryptocurrencies. There's all these altcoins like, like Shiba coin, Dogecoin, and it makes it a very risky investment because of all the ups and downs. I'm not super confident in it. Also, like with cryptocurrencies, even though they say it's like really safe, the whole point about it is that no one can just take your money. In reality, a lot of people do get hacked on their crypto accounts. They lose everything and there's no way to recover it. So one thing is you can get hacked and lose everything. The second thing is if you have your cryptocurrency on an exchange, then that exchange can go bankrupt and you lose everything, just like what happened with anyone who had money in FTX or BlockFi. The third thing is if you decide, okay, I want to hold on to my own cryptos and you have it on your own ledger or you have it on your own wallet, that's great and all, but what if you lose the password for those? Then again, any crypto that's on there is gone forever. I don't really like that. Like you can't really hold wealth this way. It also doesn't feel good seeing it go up and down so much. So for that reason, I put cryptocurrencies at a C tier. Next one we have are dividend stocks. So these are companies that are usually bigger. They don't have too much room for growth per se, but because they have such a consistent business, they want to pay their investors with some of the profits. So big companies are like Coca-Cola, AT&T, even Apple. They have all this money and they share a percentage of the profits to their investors as a dividend. Now dividends are cool because you can hold on to a stock and as it appreciates, you do get money. So this is one of the ways to get cash flow from stocks. I like it. I don't put too much money into dividend stocks because the cash flow from them isn't going to be that great. Coca-Cola was 5%, AT&T same thing, Apple I think was around 2%. So it's not going to be like a crazy amount of money that you're really going to be able to live off of. And again, because they're dividend stocks, they tend to grow a little bit slower. So for that reason, I put this at a B tier. Like it is pretty good, but it's not the absolute best. And in fact, we actually did an experiment where we put in I think $10,000 into an account. We only bought dividend stocks, and over the year it didn't grow that much. So we weren't super impressed by the performance and we decided, you know what, let's just go with the other ways we were investing before. The next one is ETFs, so exchange traded funds. So an ETF is very similar to this one, index funds. So I'll rank these two together because they're basically the same thing, but just a little bit different. What they do is they pool in hundreds of different companies, and the value of these ETFs and index funds goes up and down based on the performance of all of these like hundreds of companies in the portfolio. So that means that if 50% of them do really well and 50% of them do really bad, then the overall ETF will be flat. But for the most part, as a whole, the markets tend to go up. So these things you're probably going to get around 10% a year, and they're pretty consistent too because it's an average of multiple companies. The one downside to ETFs and index funds is that because there are so many companies in this one bunch, you probably won't see it double or triple in value in 1 year, unlike if you're buying an individual company. But the good side is because there are so many different companies here, no one company will make this whole thing fall. So this whole these things will probably not go down to zero. Like you have to have every single company money in this fund go to zero for it to actually go bankrupt. And the chance of that is very, very unlikely. Another cool thing is the companies here get switched out over time. So if a company doesn't perform as well and a new company is an up and comer, they'll switch the low performing one with the higher performing one. So you always have like the top 500 companies in these like ETFs. So another benefit too is because these are more like index funds and they're just tracking all these companies, not constantly doing like mutual fund stuff and switching things here and there. They're low cost and they're not taxed as high. So again, I think these two are definite S tiers. These go up to the very, very top. I highly recommend anyone who's investing to put most of your money into these things here because it's like very stable. You don't have to think too much about it. You know that your money is in the top companies. You don't need a lot to start. It is very, very convenient, and I highly recommend anyone who's getting into investing, you start by putting your money into these things. All right, the next one are financial advisors. Now the thing about financial advisors is this is basically the opposite of this. They will kind of tell you, okay, we're gonna hook you up with this mutual fund and we're gonna go to this hedge fund and we're gonna help you buy this stock and this stock, but they charge you. They usually charge you a decent amount, sometimes 1 or 2% of your total net worth every year. And again, you might think 1% isn't that much money, but over the long run, it is a huge financial burden. And again, at the end of the day, you could just do exactly what this guy's doing by just investing in your own index funds and exchange traded funds without having to pay this 1 or 2%. I really don't recommend this route, like putting your money with a financial advisor. So for that reason, I put them in the D category. It is just honestly not worth it. I probably would stay away. Next one is Forex. So this one is foreign exchange. You're trading USD to like Japanese yen or Japanese yen to, Chinese yuan. And you're basically trying to get the arbitrage. Like, oh, okay, like these numbers are going higher, these numbers are going lower. But at the end of the day, like this for me is a lot of work for very low profit, and the chance of you actually succeeding are actually not that high because this is a zero sum game. If one goes up, someone's going lower, and then there's fees involved. I don't think it's that great. I put this in F tier. I don't think it's worth your time. There are so many different accounts that talk about how they make like $10,000, $20,000 a day doing Forex, or they have some like robot that does it for them. Yeah, in reality, it doesn't work that great. Most people who preach Forex trading are scammers, and I really do not recommend anyone getting into this, especially as a beginner. All right, the next one is a high yield savings account. So this is different from like a checking account or regular savings account in that it will give you more interest. That's basically it. It's just like a savings account where you do have like a limited amount of times you can pull money out of the account, but they pay you at this moment, somewhere in the fours, 4.2%, 4.6%, depending on what company you go with. Now I have a link to my favorite high yield savings account down in the description, but essentially these accounts are FDIC insured, which means that if you have $250,000 in the account and that company goes bankrupt, you're safe because that money is insured and you're gonna get your money back from the government. It's nice in that the money there is liquid, so if you do need to pull it out to buy a house or pay for emergencies, you can do that, usually 6 times a month without any extra fees. And even if you had to do more, the fees aren't that crazy. So it is pretty nice for anyone that has an emergency fund or you're saving up for something big like a wedding, a big party, possibly even buying your home. I do recommend putting your money into the high yield savings account because that way the money is growing at a stable rate. And thing is, this is 100% like safe, right? Money in a high yield savings account isn't really being invested, so the money will not go down. It will always go up or stable. So I put this in a solid B tier. And above bonds, I think everyone should have an emergency fund, and all the emergency funds should be in a high yield savings account. Now the next one is life insurance. Now we're going to talk about life insurance as an investment vehicle, not as life insurance. So the thing for me is life insurance is cool because when you pass away, having life insurance makes it so that your dependents, they will be okay over the long run. That policy should cover any funeral costs. You're gone, so you're not making income anymore, so your family will be able to be okay with your life insurance policy. And generally speaking, you always get more money from your life insurance policy than when you put into it. So with that in mind, it is pretty cool. But the thing is, life insurance as an investment vehicle is very different. So the way it works is the life insurance salesman will say, okay, part of your monthly payment goes towards your premium for your policy. If you die, you get that benefit. Then they tell you to add in an extra couple $100s a month as an investment vehicle. So this money, it goes to your cash balance, and your cash balance is invested. So then they'll show you different ways that they invest. The interesting thing about this is that there is a guaranteed minimum growth amount to your cash balance, right? That's the one thing that's unique about life insurance, in that, again, this one does not go down. It grows at a minimum of, let's say, 3%. But the way they get you is that there's a maximum growth as well. So it can only grow up to, let's say, 12% a year. If it just so happens that the markets do so well that it increases by 25%, you only get 12%. And then the insurance company gets the other 12%, and they can use that to fund their other activities. So as an investment vehicle, again, I think that this is not that great, despite what the salesmen tell you. I think life insurance in itself is pretty good to have. To invest with it is probably not that great. So for that reason, I'm putting this in the D category. The next one are NFTs. NFTs. And in my opinion, NFTs are just like a fancy way to invest in art, but you add a crypto component to it. If you want to invest in art, buy actual art. Don't bother with NFTs. I think for the most part, these are big scams. People just create some BS monkeys, change the design, and charge $2,000 for each of them, assuming they're going to appreciate in value. I don't think they have any inherent value. I'm putting this in the F category. I would stay away from NFTs. So real estate crowdfunding, this is where you put in, $50, $500 to invest in a small fraction of real estate. Now the cool thing is you could say, okay, I get real estate, I get a portion of the profits. But the bad thing is by doing crowdfunding, from what I understand, you don't actually get like these amazing tax benefits that you would normally get from just owning the real estate like right out. And because of that, you're not going to be getting like a crazy amount of money from this return. They are relatively stable, but then again, because these are big commercial buildings, the performance is really dependent on the operator. So if the operator messes up, it could be a great deal, but you could still lose all your money. And because of that, I think if you're going to do this, you might as well just invest in real estate, and it's not really that worth it. I would put this somewhere in the C category. Yeah, you could put in a couple hundred, a couple thousand just for fun, but don't put all your money into real estate crowdfunding. I think it's not worth it. All right, the next one is real estate. Now real estate, again, I love real estate. My channel is called Sean Loves Real Estate. Most of my net worth is tied up in real estate, and this allows me to live a life abroad where I don't have to worry about work. I get passive income every single month. My net worth keeps increasing because the value of the properties go up, and I'm paying my mortgages down with the rents I give my tenants. It is great. Amazing wealth builder, fantastic source of passive income. However, it is not for everybody. The major downside to real estate is that it does take a significant amount of money to even buy real estate in the first place. A lot of people are asking me, Sean, how do you buy your first property? And they're already having problems saving up their first $5,000. To get into real estate, you probably need at least $30,000. This will cover their down payment, your closing costs, any miscellaneous repairs here and there. And that's just to buy one property. And again, you're probably not going to retire off of just one property. It's taken us many, many units over years of accumulating it, saving up money, buying more rental properties to be in a state where we are today. Because of that, even though real estate to me is so great, I'm going to put this in the A tier. Real estate also gives you amazing tax benefits, helps you with long-term generational wealth. I love real estate. So next one are robo-advisors. And that is kind of where you're letting an algorithm do the trading for you. Like I mentioned, like the Forex stuff, even crypto stuff. Sometimes they have robo-advisors that will help trade crypto or help you trade Forex on your behalf. Thing is, if you didn't program it yourself, you don't know what's going on in the back end, and you don't know what kind of like logic they're going to do. And because of that, I wouldn't trust this. People, want a quick buck. They don't want to learn themselves. They don't want to trust someone else or something else to do the trading for them to make a profit. But because it doesn't always work, it can leave people in a very bad situation. And I recommend, especially if you're starting out, don't be lazy. Learn how these things work, learn why these things make money, and don't get into robo-advisors. So I put this in the D category because it does help sometimes. It's not as trash as these two, but it's not something that I would go into. All right, the next one are stocks. So the difference between stocks here and these like ETFs and index funds is I'm talking about buying individual stocks, like putting 1,000 into Nvidia, putting a couple thousand to Tesla. Thing is, when you invest in an individual stock, you have a lot of potential for growth, which is really cool. But the downside is you could lose everything in one bad stock. That really won't happen with an index fund. If you put 5,000 into an index fund, it'll probably go up over time. But on an individual stock, it can be completely useless. But on the flip side, I invested in companies like Nvidia a few years ago, and their stock has increased tremendously. I would say just don't like stress over it on a day-to-day basis. Don't try to day trade. Don't try to take profit off the table too early, because here's the thing. When I bought Nvidia, it went up, it went down. But if I sold when it went up a little bit, then I probably wouldn't have bought back in, and then I would have missed out on all those gains. Stocks are really cool. They're really easy to get into as a new investor, and that's why I'm gonna put this in a solid A category, probably above real estate, because it is easier to get into stocks than real estate, but it's below ETFs and index funds because it's not as stable. And I think as a beginner, you want to have your fundamentals right and get into these first. Now, as a side note, if you want to get into stocks, I highly recommend checking out Webull. Webull is a platform where you can buy and sell stocks. You can buy and sell exchange traded funds. And the cool thing is, if you use my link down below, then they'll even give you free stocks just for signing up. You can easily track your portfolio, buy and sell shares through the desktop or through your phone. And I've been using it for years and I really enjoy it. So again, check the link down below and you get some free stocks just for signing up and making your first deposit. All right, the next one to talk about are treasury funds. So treasury funds are basically bonds from the US government. The government is saying that we guarantee that you're going to be paid this much plus this much interest over a 10-year period or a 30-year period, depending on what kind of treasury you buy. The thing is, when you buy treasuries, they're not as liquid as a high yield savings account, but you do get a little bit more interest than from a high yield savings account, generally speaking. But because of that, I like liquidity. I don't like buying a bond from the treasury and not being able to really sell it right away, to get its full potential. So for me, I'm going to put this at a C category. I'll put this above crypto though. though. I'm not really a fan of it, but it is very stable. So, again, if you're getting into it, you have a lot of cash, you want guarantee returns, people buy treasuries for that reason. But again, not that interesting to me. Okay, finally, we have money market funds. So money market funds, again, is very much like a high yield savings account, and they're basically used as a way to park your money before you invest it into stocks. So again, when you buy stocks, you can't just buy it out of nowhere, right? You have to put your money into a money market fund first, and then usually from that fund, then you buy the stocks. The cool thing is right now, actually, I've seen a lot of money market funds be insured. So like Webull has a money market fund that pays more than a high yield savings account. It pays like 5% a year and it's insured for almost $1 million. I'm going to put this in the B tier. I'm going to put this above high yield savings account just because it does pay a little bit more now, and you can use it to buy stocks. Now the downside is you can't really like pay your bills or get the money from your money market fund directly, but it's really simple to just transfer your money from a money market fund to a checking account and then pay your bills through that checking account. It takes maybe a day or two to move the money from this account to another account. So it's a little bit less liquid. So this is my investing tier list for beginners. I highly recommend ETFs and index funds. Getting to stocks and real estate is also really good. Again, with stocks, don't put all your eggs in one basket. Invest slowly and be smart with it. Money market funds, high yield savings account, these are just places to park your money while you decide what to do with it. High yield savings account is a great place for emergency funds. Money market fund is a great place to just put your money for now before you decide what stocks you want to buy. These two grow at great interest rates as of now. Bonds are good as an overall portfolio. Like for me, I put around 90% into these three and then 10% into bonds for my liquid investments. Dividend stocks, again, they're cool, but kind of niche. And I don't really think I would invest too much into these just because you can just invest in regular stocks without worrying about the dividend component because you make most of your money through the appreciation anyway. Treasury securities, crypto, real estate crowdfunding, these are again more niche products. If you are really worried about like stability, you want that guarantee return, cool, get some treasuries. Crypto, honestly, is just fun money. Don't put anything here that you're not afraid to lose. If you're taking loans out to buy crypto, you are a fool. Only put in what you can afford to lose because this goes up and it goes down and it's very painful when it does. Real estate crowdfunding, again, I just don't see the crazy upside to real estate crowdfunding, so I wouldn't put too much money into this either. You have your CDs here, which means that you're locking your money away for a relatively low interest rate. Not super exciting, so I wouldn't do it. Financial advisors, it's like, I don't even trust that they know what they're doing. If they're still working a full-time job, then they're probably not like super financially successful and they're charging a lot of money, not really worth it. Life insurance as an investment vehicle, again, what I mentioned before, it just doesn't have that same oomph that you can just invest in stocks yourself. Like if I took that $500 a month and invest in stocks, I would have way more money than by putting it here. But get a life insurance policy so that your family's okay if you pass away. Robo-advisors, it's like, I don't want to trust this guy. Why would I trust this guy? It just kind of sus to me. And then Forex and NFT, I think are just garbage investments. Not worth the time to invest in these things. And especially NFTs. Like if you want a silly looking monkey, just take a screenshot and then you have it. So that was my tier list. Again, this is my own opinion. If you guys disagree with me, I really want to know down in the comment section below why. And if you like this video and you want to see another one like it, check out this video here where I rank all of the different types of ways that you can invest in real estate. So thanks for watching this video, guys. I appreciate you and I'll see you next time. Take care.